People talk about the beginning of your firm and they look at where you've ended up and they say, wow, haven't they been so successful? But there were so many times when it could have easily gone the other way.
From Morgan Stanley, this is Hard Lessons, where iconic investors reveal the critical moments that have shaped who they are today. You'll hear about 2 out of consensus calls, one that was on the money and one that wasn't. Today on the show, Jean Salata, in conversation with Mo Asamoah, Global Co-Head of Investment Banking at Morgan Stanley. In his nearly 40-year career, Salata has been a first-hand participant in the rise of Asian markets and globalization. He now chairs one of the world's largest global private markets firms, which spans the U.S., Europe, and Asia, with $316 billion in assets under management.
Thanks for joining us. Lots to get through today.
Great to be here. Thanks for having me, Mo.
You have had a great and interesting upbringing from Chile to the U.S. to Hong Kong. Hong Kong's my hometown as well. How has that impacted and shaped your perspectives on investing, on risk, and on opportunity?
I think the way that that's shaped my outlook is to really always be thinking about things from a slightly different perspective. I've always felt like a little bit of an outsider, I would say, not quite always fitting in, but maybe slightly different than everyone else. And that's given me a different outlook, different perspective, which has sometimes been a disadvantage. Sometimes I think it's given me a broader perspective or a different perspective,
right.
And has helped me in my investing career.
You started out building a small private equity business within a larger organization, Barings Bank, of course, and then subsequently selling that business to EQT. So you obviously are chairman now of one of the largest and publicly traded private equity firms. How has that shaped your career as well?
Yeah, no, it's been a really amazing journey. When we started off, actually, we had only $25 million of assets under management. But in the midst of that, just when we were getting going, the Barings Bank actually went under.
Right.
And that was really one of my first sort of setbacks or shocks in my private equity career, was being part of an organization that was going through a pretty tumultuous period. But in hindsight, this sort of mini crisis opened up opportunities for us to eventually spin our business out, which is what ended up happening when Barings was acquired by ING, and then we negotiated with ING to spin the Asia business out. And that's sort of a recurring theme in my career, that when there's been these big dislocations or there's some of these setbacks and crises, there's always also been another door that's opened or that's created a new set of opportunities, provided you're able to survive the setbacks and navigate through the difficult periods that you're going through. The business grew, it developed, and we went from being a much more focused business around a few geographies to being a much more dispersed business around multiple geographies. And then we got to the stage where we were a fairly established large firm in Asia, and I started noticing some of the global firms changing the way they did business in our industry, moving from being just a single product, single fund focused partnership to being multi-product, larger institutionalized businesses, multi-strategies. And that's when we started to really institutionalize our business. We started to put in a lot more processes and changes to our leadership structure, so it wasn't so much centered around me as the founder. And that really set us up for ultimately what we ended up doing was becoming part of a much larger global platform. Right. I was lucky enough to meet the folks at EQT, who had a very strong business in Europe and the US, but really didn't have much of a presence in Asia. So it was a perfect strategic fit, but it was also importantly a really good cultural fit, which is ultimately why the combination succeeded.
So I'd love to understand some of your investment calls over the past couple of decades. Maybe you could start with one that was a particularly successful one before we get into the ones that are more challenging.
Mm-hmm. The one that comes to mind is a for-profit education company called Nord Anglia Education. Nord Anglia Education is an operator of international schools around the world. Today, it's actually the largest in the world. But at the time, which was around 2007, 2008, it was an industry that actually was on the radar of investors in the United States, but was not on the radar at all in Asia.
Right.
I had a very close friend of mine and who ended up being a partner in our firm, was working at a firm in the United States that was helping diligence a lot of private for-profit education companies for private equity firms. And I was talking to him about it, and I was thinking, wow, for-profit education. And I remember even discussing with some of our investors at the time, and they felt like, are you sure you can even invest in the education sector in Asia? Is it even allowed? What are the regulations? How do you generate profit? And so we did a sort of a top-down market mapping exercise of education assets in Asia. And to our surprise, there were actually 3 pretty sizable for-profit education schools in China at the time, but they were owned by a UK-listed company.
Got it.
And so this is before the days of sort of cross-border investing being that well known or practiced in Asia. We decided to take a trip to London. We met the company. We said to them, we're an Asian private equity firm, and we can actually help your business in our part of the world, which they found quite intriguing because they were having trouble penetrating the markets in Asia, and they felt that as a private company with our backing, they could do a lot more. And we took, the time it was a business with 6 schools, bought it for something like $300 or $400 million at the time in total enterprise value. And over the last sort of 15 years, we've owned it in subsequent funds and vehicles, and we've taken it now to over 90 schools around the world. And we just recently transacted on the asset at over a 14 billion enterprise value. So
Reasonable return, I think, right?
Yeah, not a bad return.
Yeah.
But looking at new sectors and how you can tackle deal constructs that are a little bit different, I think is a way to generate some alpha in our industry.
What lessons did you take away from that initial investment as you thought about the success?
I think there are a number of key takeaways from this that we've tried to replicate. I think number one, there was a very big consolidation opportunity in the industry. It was a very fragmented industry. Most of these schools are individually owned around the world. So there's an M&A kind of roll-up opportunity, which I think is a really good playbook for value creation that we've subsequently executed on in multiple different industries. Secondly, we gained a very strong appreciation for businesses that have these kind of recurring revenue type business models. Right. Tuition in this case it's prepaid. You get paid in advance. Very favorable cash flow characteristics that enable you to utilize the cash in the business to make acquisitions or to invest in further growth. The other key takeaway from this business is that actually the business went through some very challenging periods. We had actually right after we bought the business was the financial crisis in 2008, which nearly took the whole business down. So we had to get through that. Then we had a very tough and challenging period during COVID as well, when people weren't going to school. But we invested in the technology platform. We developed a really good online offering at the time. And I think that was also a key lesson for us, was that the more you have control of a business, the more you can really drive value creation, the more that you can really be in control of your destiny really on the investment.
Can we talk about an investment perhaps that didn't work out as well as you thought? Tell us what was the original thesis and why it didn't play out the way you thought it might?
Yeah, I think you learn a lot more from your setbacks and your failures and mistakes than you do from your successes. As I think back to the early stages of our business when we were just getting started, we had a very strong China business that was growing and doing well, and we decided that the next phase for us was to start investing in India. And India was a relatively new private equity market at the time. You're talking about more than 20 years ago in the early 2000s. And so we started investing in really a broad range of companies there. There were opportunities, but I would say that we were not being very systematic about it. And what ended up happening is that we made a lot of minority investments in a lot of different companies, in a lot of different industries, which mostly ended up not working out. And it was a real setback for us.
Was there a moment during that early journey in India where you said, it's not working, we have to pivot? Was there a mindset shift or something that made you change?
Well, it started building as we started losing money on investments, which none of us like to do. And viscerally, when you lose money, for me personally at least, it just bugs me. And of course, I had to go and tell our investors the bad news when we were losing investments. So our investors were asking, why are you bothering going into other markets that you don't really understand? The easy thing to have done at that time would have been to say, you know what, this is too difficult. This market doesn't work for us. We don't know how to operate here. I nearly got to that conclusion, but that's when we sat down and said, let's stop here and evaluate and figure out what's going wrong and how we fix it. First we said, do we have the right people or do we have the wrong team? And we actually came to the conclusion of the right people. But what we were doing wrong, we had the wrong strategies. And what we changed subsequently was, number one, we stopped making minority investments because we felt like it was very important to have control. We had issues with governance, so we shifted from minority investments to control investments. The second thing we did is that instead of being opportunistic and investing across whatever deals we found in the market, we decided let's analyze this top down. Let's look at the market. Let's try to understand where the biggest growth is going to happen and where the best private equity type opportunities are going to exist and where the most controlled deals are going to exist. And we came to the conclusion that IT services, the technology sector, was the big sector for us to be focused on. And we basically exclusively focused on that one sector for, I would say, almost 10 years. We also started really doubling down on professional management, avoiding founders or promoters, as they're called in India, and really working with professional CEOs that we would bring in who were very aligned with us and driving value creation together. And it did actually take us, I'd say, another 2 or 3, maybe even 4 years before we made another investment, having to reorient it ourselves and started to completely generate a whole new pipeline of opportunities based on this new outlook, this new strategy that we wanted to execute on, and sort of building our conviction. That strategy worked,
Yeah.
and we went from having the worst performance in our portfolio in India to having the best performance in our portfolio in India in our subsequent funds. So the takeaway for me from that was, it nearly put us out of business, moving into a market where we didn't have our strategy right yet, but having refined it, we were able to then deliver great results, which ultimately ended up strengthening our business. And if I look back at what enabled us to do that, I think it really kind of boiled down to, first of all, just being very honest and open with ourselves that we weren't doing a good job, and being able to have a transparent discussion around that. And then secondly, I think it's this idea of kind of learning agility, of like constantly trying to improve the way you do things and figuring out what you can do to make your business stronger, rather than taking every setback as a sort of a negative experience. See how you can figure out what you can do better next time.
I guess part of the lesson for me, at least, is something's hard. Rather than walk away from it, pause, reflect, think about what needs to change, and then go back in if you have the conviction to see it through.
Yeah. And this is where your team members really come in. I mean, none of us can do this on our own. It's a tough situation to be in. A lot of these periods are coinciding with setbacks overall in the industry, or fundraising being challenging, or wondering whether you're going to raise another fund ever again, or your team getting demoralized. So people talk about the beginning of your firm and they look at where you've ended up and they say, wow, haven't they been so successful? But there were so many times when it could have easily gone the other way, where you're nearly thinking about giving up.
Right. How was it retaining the right people, making sure that those that were with you early stayed with you through it, especially the ones that were the strong performers, and that they weren't swayed by, I'd like to do something different?
That was always one of my biggest worries. And to this day, it's probably the single thing I think the most about is the team, and making sure the team is happy, healthy, strong, and developing well. On the one hand, you need to have the economics right. You need to have the ownership structure right. On top of that, though, there's this cultural element of, it's a little bit self-selecting. You're bringing people in that have good chemistry, that work together well, and that have a sort of a shared view of what they're trying to build together. We always had local decision making in terms of how our investment decisions were made. We were an Asia-focused business. Some of our competitors were making decisions at the centralized level in the US, say, or in Europe, kind of imposing those decisions down into the region. That, I think, can be very frustrating for teams and demotivating. So that's part of sort of the way the business is set up. So I think it was a combination of these different aspects of how we built the business and the kinds of people in our organization, how we incentivize the team. And I'm happy to say that we ended up having one of the longest tenures of our team members in the whole industry in Asia. Average partner in our firm has been with us 17, 18 years. And I think if you get the people and culture right, the investment performance follows.
You've said the word culture now many times, which is great. It's very much what we think about at Morgan Stanley as well. And so as the firm has grown, obviously now with EQT as well, some of those lessons from the early days around control, governance, focus, disparate versus a more deep down focus in certain businesses, that I assume carries through to today as you go through your buyout IC or some of the other strategies that you pursue as well.
Yeah, absolutely. And we're constantly trying to refine everything we do all the time. This sort of, we call it the infinite mindset. We talk about that a lot. This idea that the game's never over. Just when you think you're won, or you've done the best deal, or raised the biggest fund, or have the best performance, or even the top quartile performance, you're only one fund away from that disappearing. We're in a very competitive industry. I've sort of always viewed myself and our business as a little bit of an underdog. I still have that underdog mindset, I would say. We have these big global firms that were coming to Asia and setting up shop,
You were the incumbent.
we were the incumbent, but these new entrants were bigger players globally. They were smaller in Asia, but bigger globally. They had more resources. We were worried about what that meant for our, the brand that they had, and how do we compete against that. And so I think continuing to maintain that underdog, or we call it entrepreneurial mindset, I think is really important. And actually, it gets harder to do as you get bigger. The tendency is, I think, to become more conservative and to start to do the middle of the road type of investing, which ultimately will give you middle of the road returns.
Yeah.
And I think we need to always avoid that while managing risk.
I love that healthy paranoia equals an infinite mindset, something like that. That is a fantastic way to think about things.
Yeah. Yeah, I think that's it's a good kind of model even for life generally,
Right.
to constantly try to learn and stay curious. Part of that is having huge respect for your competitors.
Yeah.
I think when you start feeling like you have all the answers and you don't respect your competitors, I think you can get into trouble. We operate in an industry with some fantastic firms who really are good at what they do. And I think one of the advantages, if you want to call it, that we had is we were in a market, a kind of more of a frontier market in Asia. So we were able to sort of look at what was working and being done well in the US markets by the big established firms that were succeeding, and trying to bring that to Asia, but then adapting it to local conditions, which often involved slightly modifying it, particularly coming back to this point on culture. The one size fits all approach, which is the more the US model of operating in a big homogenous market, that doesn't work in Asia. Every market is so different, and you need to really adapt to local market conditions. So it's sort of taking the best of what the global firms were doing at the time and adapting it to local conditions.
What in Asia right now interests you?
I think the single biggest opportunity we see in the region today are Japanese buyouts. That market is growing. It's a market where we think there's a lot of excess return opportunities available to investors. It reminds us a lot of the sort of conglomerate days of the US in the 80s, where you had businesses that lacked focus, that weren't executing to full potential. We're seeing a lot of take private opportunities there. And I think generally there's a policy tailwind in Japan related to the corporate governance reforms that have been implemented by the Tokyo Stock Exchange, which you probably know well, because I know Morgan Stanley is very active in Japan. In fact, I think you have a local partner
We
there
have our
that's-
tie-up with MUFG, which makes us the largest securities firm in Japan. So
Exactly.
we share your passion for what Japan is becoming.
Yeah. And I think that partnership is super strategic, because it's important for us as well when we think about working with a financial advisor. The fact that you have that local capability is really critical, because there's a lot of relationships that are very market specific there. But we have a very active pipeline there. We've made a number of investments. We've announced some take privates recently. And so I think the opportunity there is going to continue to generate more and more deal flow for all of our industry, actually.
So let's go back to the theme of hard lessons again. Can you maybe share one other hard lesson that you've learned over the years, whether it's in your personal or in your career, that perhaps made you stop, think, and reflect?
I think a general kind of thread that's run through both my business career and my personal life has been the setbacks that I've experienced, of which there have been many, and I think most people have setbacks in their lives and in their careers. Well, even now, if you look at AI, AI is potentially a very disruptive, very challenging, kind of scary development in the world. And so if you step back and put it into the context of, well, we've been through many changes as humanity before. We've seen technological change, disruption, war, COVID, and other sorts of calamities, but you're able to sort of navigate through these things. It requires constant iteration, constant thinking around different ways to think through these challenges. But I do feel like it's important to look at some of these setbacks as a way to redefine the way you're going to move forward, and to almost reinvent your business. And we've had to pivot our business many times. In fact, there's many times when it could have gone completely the other way, but we've been able to pivot the strategy, or pivot the team's focus in a way that ultimately ended up succeeding. And I talk to my kids a lot about this as well, that when you have these setbacks, which are going to happen no matter what, the question is how you respond to them.
I go back to what you said earlier, the infinite mindset.
Yeah.
It's really fascinating. Jean, that was great. Thank you for joining us on this Hard Lessons. I know all of us at Morgan Stanley will take a lot away from this, so I appreciate the time, and I hope to see you soon, hopefully in Hong Kong.
Well, thank you so much, Mo. I really enjoyed that. Thanks very much. It was a
Thank
great
you.
conversation.
Great to see you.
Likewise.
You've been watching Hard Lessons, an original series from Morgan Stanley. You can listen to an extended audio version of this episode on Apple, Spotify, or wherever you get your podcasts. For more information about the series, visit morganstanley.com/hardlessons.